Okay, now we move to the other approach to computing GDP, which is the income approach. The income approach, as you can see, to computing GDP consists of two steps. The first step is computing national income. And then after computing national income, we have to make certain adjustment to national income for certain things to eventually come up with GDP, Now, national income first consists of compensation of employees. Then national income is computing by adding those 5 items, as you can see in underneath this flow chart. So national income equals compensation of employees plus proprietors' income plus corporate profits plus rental income plus net interest. So once national income is calculated, then we have to make certain adjustment for some things. These adjustments include that we have to subtract from national income earned from the rest of the world, plus income earned by the rest of the world, plus indirect business taxes, plus capital consumption allowance, plus statistical discrepancy. So once these adjustments are made to national income, then eventually we will have a value of GDP using the income approach. Remember that money is spent to purchase goods and services eventually is an income in the hands of the seller. So money spent to purchase goods and services will end up going to the resources that produce that these goods and services. Therefore, an expenditure for one person eventually is an income for another. Okay, so now as you can see, once we make the adjustments to national income, we will have GDP using the income approach. Now we explain the components of national income. As you can see, national income consists of these 5 components. Let's explain these 5 components. Compensation of employees first consists of wages and salaries paid to employees. Second, it consists of employers' contribution to Social Security and employee benefit plans. So anything that the employers contribute to Social Security is part of the compensation of employees. The third part of compensation of employees is the monetary value of fringe benefits. Now, as you can see, fringe benefits consist of Social Security, consists of health insurance, free breakfast and lunch, gym membership, and others. It is important to notice that monetary value of fringe benefits is the largest component of national income. Now, the compensation of employees, as we said, consists of these 3 parts. Now we move to proprietor's income. What actually do we mean when we say proprietor's income? Proprietor's income, this type consists of all kinds of income earned by self-employed individuals and owners of unincorporated businesses. When I say self-employed individuals, of course, we mean that somebody who is not working for a specific employer. He usually earns income by contracting with a business directly. That is the meaning of self-employed individual. Now, as you can see, the owners of unincorporated businesses, we mean here farm and non-farm business owners. Now, the third type of course, national income is corporate profits. As you can see, corporate profits include or consist of all income earned by the stockholders of corporations. Some of these profits, of course, are paid to stockholders, of course, in the form of dividends. Some others are kept inside the firm to pay for investments. Of course, some others also are used to pay corporate profits. The fourth type of national income is rental income of individuals. It is the income. What actually do we mean by national income of individual? It means the income gained by individuals for the use of their non-monetary assets, such as houses, offices, land, of course, and others. It also includes an imputed value to owner-occupied houses. That is, home ownership is viewed as a business. So those who own homes, okay, they are viewed as the owner of a business. And that business produces usually a service, okay, that is sold to the owner of the business. That is, the owner of a house is viewed as the owner of a business, and the service that his business is giving is usually, of course, sold to the owner of the house. Now, the last part of national income is net interest. As you can see, this net interest is equal to the interest income, of course, received by households and government, minus the interest they paid out. So it is the difference between the interest households and government earn and the income or the interest income they paid out. Now we have to calculate GDP through the final process, which is we have to make some adjustment for national income. So these adjustments consist of the following. So we have to subtract from national income the income earned from the rest of the world. What that means, income earned from the rest of the world. This is the income that national citizens earn from producing and selling abroad. This is the income that national citizens earn by producing and selling abroad. So we have to subtract this income that is earned from the rest of the world. Then also we have to add the income earned by the rest of the world. This is the income of non-citizens who, of course, earn income by producing and selling inside their domestic country. Okay? Then, of course, after that, we have to add the indirect business taxes. Indirect business taxes consist of excise taxes, sales taxes, and property taxes. Sales taxes are the taxes that we pay when we buy most of the goods. Excise taxes are taxes on special or certain goods such as fuel, tobacco, alcohol. So we pay excise taxes on those. And the property taxes, of course, the taxes that are paid on property. Plus, then also we have to add the capital consumption allowance. Capital consumption allowance, as you know, capital goods are used up in the process of production due to wear and accidental destruction. Therefore, the cost to replace these capital goods is called capital consumption allowance or depreciation. Plus statistical discrepancy. In calculating GDP or national income, usually GDP is calculated at by using different data sets. Therefore, some computation errors will take place, and so we have to take into consideration statistical discrepancies when computing GDP. Now we move to the third approach to computing GDP, which is the value-added approach. What actually do we mean when we say value-added approach? Now, value-added approach consists of summing the value added at each stage of production. So for instance, over here in this example, we have 4 stages of production. So we're going to add the value added at each stage of producing a bread. Now, what actually is meant by value added? Value added is equal or is defined as the value of output or the value of production minus the value of the input or intermediate good that goes into the production of that output. Therefore, in this example, as you can see, we have 4 activities of, eventually having a bread. The first stage of producing bread start with growing a wheat. Now, growing a wheat, of course, the farmer doesn't have any input that enter into the production of a wheat. Therefore, the cost of the intermediate good in this stage of production is 0. And he sells the wheat, okay, and for $1. Therefore, the value added in this stage of production is $1. $1 minus 0 is equal $1. $1 minus 0 is equal $1. Now the wheat mill, of course, the wheat mill will buy the wheat for $1, okay, and then after grounding the wheat, he will sell it for $1.30. Therefore, the value added in the second stage of production is $1.30 minus $1, and which is 0.30 cents. Okay. Now the bakery, of course, it is its cost or the value of the intermediate good, it is $1.30. The cost of wheat or the cost of flour is $1.30, and he sell once he makes the bread, it sells for $2. Therefore, the value added in this stage of production is $2 minus $1.30, and we come up with 0.70 cents. Now, eventually, the bread will go to the bread distributors, and from there to the consumers. Okay. Now, the bread distributor received the bread for $2 and will sell it to the consumers for $2.80. Therefore, the value added in this last stage of production is $2.80 minus $2, and we come up with 80 cents. Therefore, now GDP now is the sum of the value added in all stages of production. $1 plus 0.3 plus 0.7 plus 0.80, we come up with $2.80. This is the GDP, the value of GDP, which is the sum of the value added in all stages of production. By the way, this 280, the sum of the value added is the same as the value of the final good, which is 280. So the value of the final good, which is the value of a bread in the when it comes to the consumer, is $2.80, and the value of the sum of the value added is $2.80. Therefore, this is the value of GDP, which is the same as the value of the final good. Now we go to discuss 3 measures of GDP. The first one is net domestic product. Net domestic product is the measure of the new good available in the economy after taking away the worn out capital goods. As you can see, is equal to GDP minus capital consumption allowance. And capital consumption allowance, as we define it, is the cost to replace those worn out capital goods that have undergone wear and accidental destruction. So after taking away these worn out capital goods, we come up with the value of the new goods available in the economy, and this is called net domestic product. Now we move to the second measure of output, which is called personal income. Personal income is the amount of income that individuals actually receive, because there are certain incomes that are earned but not received, such as undistributed corporate profits, social insurance taxes, and corporate profit tax. These are earned income but not received. So therefore, we have to take them away from national income, of course, because these are not received income. But we have to add to national income transfer payments, because transfer payments is received income but not earned income. So personal income is equal to national income minus those incomes that are earned but not received, plus the transfer payments, which is received but not earned income. Now we move to the third measure of output, or GDP, is disposable income. Sometimes it is called spendable income. This disposable income is equal to the personal income. We just calculate its value here, minus the personal taxes, usually income taxes. Okay, so this disposable income is usually used to either consume or save. That's why it's called spendable income.